Hi, I'm Bleasdale, Director at Azets Wealth Management. I'm joined today by John Kean, who's a private client tax partner at Azets UK. During the session, we're going to discuss how individuals can successfully manage their pensions in retirement. Pensions have been central to retirement planning, and the changes announced in the budget in 2024 have meant that there's become a lot more attention. We'll be discussing those today and perhaps some of the changes that our clients could be making to improve their financial position. John, firstly, what has actually changed with regards to pension tax and inheritance tax rules?
Well, big changes actually have been announced by the government last year in the autumn statement. Just to set the scene, I suppose, currently unused pension funds can be passed on to your loved ones, onto your beneficiaries of your estate, inheritance tax free. So all good. However, from April 2027, unused pension funds will come into your individual's estate for inheritance tax purposes. In broad terms, that means that pension funds could be exposed to up to 40% inheritance tax on death. So obviously that's a big shift. Aside from inheritance tax, we do have a potential double tax issue as well. Once inheritance tax on the pension pot itself, then potential on the beneficiary as well when it comes to drawdown income tax on that beneficiary. So big changes on the way from April 27.
And what do these changes mean in practice for those individuals who have those larger pension pots?
Well, I suppose the main thing is, because it is such a big change, is that people really need to start reviewing their overall strategy for their estate and how that passes on. I think before, the default was, certainly from a tax perspective, was if you can leave your pension pot untouched, do that, just leave it as is, because if you hold that pension pot on death, there's no exposure to inheritance tax, provided a few other conditions are met, of course. So the planning had always been, if you have a pension pot, leave that till last. Mm-hmm. Whereas I think, and from a tax perspective, it can still be very good, but certainly from maybe your perspective, from wealth planning, the whole mindset is changing, and actually that may not be the best approach for people. So what was once leave your pension pot till last, do you now draw on that first? Mm-hmm. And use and leave other assets for later. So I think it's more of a mindset change, and actually there needs to be really a deep understanding and review of your own assets to see what is your best approach, because leaving pension to last may not be one best financially or from a tax perspective.
Certainly from a wealth management perspective, we're seeing a big sea change there, because it has been, as you say, almost quite simple that you would draw down other assets first, but now we're actually having these conversations. We're looking at annuities in more detail. We're looking at options for drawing down the pension pot, considering the taxable suffer now, but as income tax versus paying inheritance tax plus potential income tax in the future as well.
Yeah, I think from your perspective, and we've never spoken so much about life insurance as well, because some of these pension pots are huge. So that immediate exposure, people thinking more about life insurance policies, which you know a bit more about than me, obviously. But these are new and interesting conversations, and there has been such a big shift that, some good conversations, but it is causing concerns.
So John, I guess beyond inheritance tax, what are the other tax considerations we should be thinking about when we're talking to clients about pensions?
Yeah, well, the inheritance tax news is obviously big news and not welcome, but what I would say from a tax perspective is pensions are still a pretty good vehicle for tax efficiencies. For starters, from an income tax perspective, contributions made to pensions are tax relievable. Currently, you can contribute up to £60,000 per year, or 100% of your earnings, whichever is higher. And also, people should remember that they can also use unused allowances from previous 3 years as well to maybe give some more relief in any given year. And once those funds are within the pension, they're going tax-free as well from year to year. So there is inheritance tax at the end, but these things should not be forgotten about. And currently, we still have the 25% or up to 25% tax-free lump sum. Whether or not that remains in place come budget day is another matter, and maybe a point for discussion later. But pensions are really good. Generally, the IHT issue is something that's made that a bit less appealing, but they can still be a really tax efficient vehicle.
Yeah, well, we sort of feel the same way. So definitely the legacy piece has been eroded by the introduction of inheritance tax in 2027, but still we're talking to clients who are looking at their retirement, who are thinking about saving, who have companies where they're trying to extract profit tax efficiently. Pensions still really do have a place.
Yeah.
Just maybe when we're thinking about as a vehicle to pass on assets to the next generation, probably not in the same way.
Yeah, I think, I mean, pensions have always been forefront. I mean, there are other investments as well. I mean, you've got investment bonds, you have ISA. People should also look at using up their ISA allowances, again, subject to speculation and things that could change come the end of November. So there are things that can be done, but pensions are, from a tax perspective, still forefront in my mind, at least, when we're having these discussions with clients. So well, I suppose, obviously tax efficiencies are great, but from a financial planning perspective, I mean, how are these changes affecting the way you're advising clients at the moment?
I think it's just adding a layer of complexity to the conversations that we've been having. It has been quite straightforward at times, saying spend these assets first, leave pension for tax efficiency to the future. Whereas now it is more nuanced, where there is available personal allowance, we should be probably looking to draw down perhaps pensions, or we're looking again more closely at annuities than we have done previously. Gilt yields and changes to the death benefits have made annuities a lot more attractive, and the rates are higher than they have been as well for a number of years. So it's making I guess we're adding more value to the conversations we're having with clients because there's more to discuss in those conversations.
Yeah, I think from a tax perspective, again, I think people seem to really embracing the change in terms of having conversations and maybe considering things that they may not have considered before. Trust conversations, for example, we're having a lot of those. So I think that people are doing the right things, having the right conversations, and people should continue to do that. I think. I suppose from a tax perspective, a frustration throughout the profession, I suppose, is people maybe a bit too late, retrospective planning. From a financial planning perspective, what's the sort of maybe mistakes to approaches that you see most often from clients generally? The
mistake that a lot of people make is as you say, leaving it too late. Coming to the professional at the point at which you're about to retire and saying, here's the pot, what can I do? And that's okay, and we can help at that point, but actually it's much more helpful if people come to us earlier. I mean, really the earlier the better, because you can have decades hopefully of compounding on investment growth. But I think a lot of people will go into the pension scheme through their employer. That's a lot of people's pensions will be through their employer, and they'll go into the default investment strategy. And that may or may not be appropriate depending on their situation, on their objectives, how much income we need in retirement, their other assets. So sometimes they get to retirement and they've been in a default strategy, or they've had a wee go at picking investments themselves. And actually, by the time they get to us, they missed out on massive opportunity to have a better return and a better pot. So I guess what would encourage anyone who's thinking about retirement, which hopefully is everyone, is speak to financial professionals sooner rather than later, and make sure that your plan is on track, or if it's not, what steps you can take to make it so it would be.
Yeah, I think that's a great point. It's so often the case that when we're speaking to clients, they are sort of living in the past almost in terms of retrospectively, because we're dealing with tax liabilities from years before, and actually having that time to look forward. And for example, I know you guys do your cash flow planning, which is fantastic, and people really need to think about what's their ultimate aims in life as well, their goals, their family goals, because things change and that's fluid. So people should be reviewing fairly regularly. I mean, for me, I suppose people should be regularly reviewing, at least annually, what their overall plan is. I'd say more regularly than that. Life events. Life events such as children can be expensive, as you and I both know, and things change. So keeping that under constant monitoring is important. From your perspective, is there any sort of general advice in terms of how often people should review, what's coming up, their cash flow? How often should they look at their goals and their sort of tax basis, I suppose?
We would say at least annually. So if there's been a major event, children, marriage, divorce, then that can be a reason to review it. But generally, at least annually, make sure it's on track. And as you get closer to your retirement date, we're doing pension planning here, then you probably want to be a bit more eyes on it as you look to Do you want to de-risk part of the portfolio to buy an annuity, to provide tax-free cash? So in the last few years before retirement, particularly important, but as a general rule, would say at least once a year. And I think the mistake some people make is they set something up, they have an interest very briefly in their pension, they choose some funds, and they go off and have their career, have their life, have their kids, and they come back to it 20 years later and go, oh, a lot's changed in those 20 years, but I haven't reacted. And that's again why working with professionals, we do reacting hopefully on your behalf.
Yeah, absolutely. And so much changes in such a short space of time. We've obviously got political landscape, both at home and worldwide as well. It's quite, let's say, unsettled and interesting times at the moment. So yeah, maybe more regularly is key at the moment.
Yeah.
So, I suppose obviously pensions have traditionally been forefront. But I suppose from your perspective, how do things like ISAs, investment, investment bonds, property, for example, how do all these things compare, or is it bespoke and no one case is the same, obviously? But have you got any input as to how you're now looking at those types of investments versus pensions, I suppose?
So with our clients, when we're talking about investment portfolios, we always talk about diversification. They're spreading the risk across different financial instruments, shares in different companies, different countries, different sectors. When it comes to vehicles and assets for saving for retirement, it's the same thing. We talk about diversification. So some clients will have large property portfolios, but maybe have neglected their pension. Some people have a lot in pension, but not much else elsewhere. And that puts you at risk. We saw in the last budget that the government's quite happy to change the rules around pensions. And when you hold too much in one specific product or tax wrapper, then you're exposed to a risk there. So we would always encourage our clients to spread across multiple different types. ISAs certainly have a place, particularly for a lot of our clients who have big pensions. They're acutely aware that they won't be able to draw down their pension until they're 57 years old. But actually maybe they're in a position where otherwise they would like to stop working. So if they have money in things like a stocks and shares ISA, that might be creating an opportunity for them perhaps to retire a couple of years earlier, use the ISA for bridging before they're able to access their pension. So I guess the short answer is it all has its place, but it has to fit around your overall lifestyle plans, and diversification is key.
Yeah, of course, and everyone's got different ambitions and goals as well, what they want to do in retirement and how they want to preserve wealth for future generations. So yeah, that sounds good.
How important is it that financial planning and tax planning go hand in hand? As you know, we're in a really fortunate position at Azets where we have both disciplines under the same roof.
I mean, can't really stress how important it is. I mean, it's crucial. The complexities on both sides. I mean, you're a qualified tax advisor. For example, we can talk about the tax implications of certain investments and pensions, but I'm in no way qualified or know half of what options there are available. I think options is a key thing from a wealth perspective. Pensions is one thing. There's so many other things you could be doing. So you want to be sure on both fronts that when you're doing, first and foremost, setting out what your goals are, what your cash flows look like, what you want to do with your money ultimately. Does it actually work financially based on projections that, say, the wealth team and yourself would carry out? And actually, by the time you then factor in what tax you'll be paying, what HMRC will take from that, what does that actually look like? And that can't be done any other way than a joint-up approach, in my view. So, yeah, hugely important.
Absolutely. I feel the same way. It's a client can come to us and we can do the whole thing from sort of stem to stern. You come in, you can get a report on your current position, put a plan in place to fix that, and then we do the correct reporting at the other end as well. So no, I agree. Been really beneficial for our clients.
Yeah.
If you're meeting someone for the first time in a while and they hadn't reviewed their pension arrangements in a number of years, what steps would you be recommending that they take?
Certainly, as spoken about before, would recommend that you review it at least annually anyway, but if it's been a few years, certainly my advice would be do it now, carry out a review of, your full assets, full asset base, values, what those are, how those are made up, what's your potential inheritance tax exposures on those. And if you've not reviewed these things in a few years, has your family dynamics changed? Have, your overall ambitions in life, what you want to do in retirement, have those things all changed? Start thinking about that and have the right conversations, whether that be with your existing advisors or financial advisors. I think that you just need to know what the current lay of the land is and what your options are. So I think if you've not done it in a few years, certainly look at doing that, as a matter of priority.
Yeah, no, I agree. We are certainly finding that clients who've had pension pots perhaps for a number of years, there may be valuable guaranteed benefits that they're not aware of. So sometimes speaking to them, they maybe just see a number on a statement they get once a year, but actually when we drill into it, there's perhaps guaranteed annuity rates, guaranteed protected tax-free cash, or maybe there's things in there that we don't really like and would be reasons to perhaps transfer away. You talked about death benefits, some old school pensions are not set up to pay out in a tax efficient way if you die after 75. So again, really worth having a review for those clients.
Yeah.
Thank you, John, for your insights today.
Yeah. Thank you.
It's clear that pensions remain one of the most important tools that our clients have in terms of looking towards their retirement and their general financial planning. More important than ever is that people are seeking advice and getting professional oversight in terms of their affairs and what they're doing. Please do reach out to myself or John or the wider team if you'd like to talk about your pensions or anything else.